When I met you in the summer, maybe heaven right now is a devil or angel away. That won't change. Together we vow that our colors will sparkle to fade. And I will find you. I will find you. I will reach you.
It's time!
Good afternoon, everybody. What is going on here on the Stocked Up live stream? Wow, it's a crazy day out there in the stock market. The SPY started dipping out of nowhere. Trump came out with some pretty negative Nvidia news today. I don't know if you guys saw this around the middle of the day. Unusual Whales had it on Twitter. Trump officials discussed tightening curbs on Nvidia chip sales, restricting Nvidia's H200 chips. That could be pretty rough if they end up doing that. Now, they say that they're discussing it. Doesn't mean it's going to happen for certain there, but let's go. What is up, everybody? We're going to have the big man, Jerome Powell, coming out here in just a moment. Or sorry, in 30 minutes. We're going to have the decision coming out in just a moment. I'm going to do a poll. I am typing out the poll as I speak. So pardon my misspeak there. But the SPY, that is pretty rough, though. It dipped all the way down to $600, which we've talked about $600 as being a major psychological level. Of course, where does it bounce? Could you guess? Right on the head there. All right. All right. This poll coming out's a quick one. Will the decision send stocks down or up? We're going to do down, up, and we're also going to have sideways / neutral here. I'm voting for sideways / neutral on the decision, but after the decision comes out, we will be starting to get into what Jerome Powell himself is going to be saying. We're 3 minutes out from this decision right now. Going to be a big one. We're going to throw up the Thinkorswim news with the SPY, of course. We're going to have CNBC open. Going to be looking all over the place here. See what we get. How's everybody's afternoon, though? I hope everyone's having a good one out there. You guys like the music today? I hope so. Tried to get some hyped up music here for this live today, this afternoon. The best of the 2010s bass boosted. Neutral is what you're going for, Tangy Man says. TLT must go up tomorrow, Isaac said, and then he said maybe. It must go up tomorrow, maybe. I like that. TLT trying to bounce a little bit. You know, looking at the daily, we had that recent big money play with TLT, $3.2 million. That's a big one. It expires pretty soon as well. If TLT does not get a positive reaction today, that's going to really hurt the potential of this big money play here. So today's like a make or break day for TLT. All right, let's see that SPY because we're going to have the action coming in just a moment. Here we go. We're sitting just above 600 right now. $30 seconds out. The suspense is killing me. What are you guys thinking? Let's see that poll. It was a quick poll. Get those votes in. 46 votes in this quick poll. That is a good quick poll. It's a tie. Oh my gosh. Wow. I haven't seen a poll that close in a long time. All right, it's 1 or 2 technically Eastern time. There's the poll. Down officially wins the vote. Looks like SPY is dropping off a little bit here. Let's go. All right, SPY. We're going to see $600 test. Now we could see a bounce off 600. Definitely going to be watching this closely. Come on, 600. Let's see. It's right there. Oh my gosh. Come on, CNBC. How's our news here? I'm eyeing up the news on the SPY. Oh, here we go. They paused, of course, just like we thought. Holding rate steady, pausing. The headlines just started hitting. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Let's see what they said here. The committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data. Oh wow, what's new? They're going to look at incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. In assessing the appropriate stance, they're going to continue to monitor the implications of incoming information for the economic outlook. All right. Committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market, inflation pressures, inflation expectations, and financial and international developments. Wow, surprise, surprise. Who would have guessed? And SPY is sitting here going crazy. Wow, so they're going to be looking at incoming data. They leave rates pause. They're kind of leaving people with a question mark right now. Of course, we're going to be looking at lots of different articles and stuff with this over the next 30 minutes as we get into it. But how do you guys like this? So far, SPY has done nothing. It's been moving neutral. I would say the sideways voters are the ones that won so far. But if we start to see the low of day on SPY breakdown, then I'll say we're going down. I'm going to go with neutral, Panda. Very neutral here. Jane, the market is really just stabilized. We kind of have a range right now between 600 and 603. The SPY is stabilizing in between here. Not really doing much. I'll let you guys know, though, if it starts to move through, up and out, or below here. I'm going to put an alert at the low of the day, and I'm going to put an alert at the high of the day. So we'll get alerted either way. Tangy Man got some SPXS calls. Hell yeah, and if you guys are new here, make sure you destroy that like button. We're at 13 likes. Let's get those likes going. Also, destroy the subscribe button. Definitely helps us out there. This is separate from the nightly channel, so definitely helps us there. While you're at it, go check out the new Instagram, the Stocked Up Instagram. Let's go. I'm going to throw the link in the chat for that. Go give us some follows. Also, destroy. Definitely throw some follows out there. I don't know how I just had a little echo go on, but we stopped it right away. My accounts all went up and down $1,000 and then right back where they were. Yeah, pretty volatile here on this initial move. Let's go check tech. Nvidia, very neutral, stuck right around the low of the day. I will say, though, guys, I'm leaning more bearish here. Uh-oh, SPY is about to test that $600 level once again, getting closer to the bottom of the range right now. Looks like QQQ's turning over as well a little bit. Microsoft. Let's check Amazon. Same thing. Getting closer towards the bottom of this small range. Apple. Google has been, what, fun one lately. They're still not very close to their low of day yet, but jokes in the options chain. Oh, jokers in the options chain. Bacon said Tesla is hitting 1,800 by Friday. You heard it here first. Holy shit. If it does, Bacon, I will drop dead. No, I'm just kidding. I won't. Definitely won't happen, but if it does, I don't know. I'll buy a Tesla, maybe. If it's 1,800. UVXY ain't blasting yet, Sean said. UVXY. Not yet. It's close. It started moving really well in the middle of the day with that Nvidia news. That Trump Nvidia news was pretty good. Nicholas said Nvidia to 600. Let's see Nvidia here. Gosh, you guys are throwing out some crazy targets. I'm watching Tesla. It's falling down. It's actually bouncing off of the trend, though. This has been a Interesting trend line the past few days. It's moving under this lower trend, but the funny part is it's bouncing off the higher trend. This is going to be a big worry, though. If Tesla gives out at the low of day, it's going to be brutal. Honestly, with the price action I'm seeing now, I would probably lean down on Tesla, but of course, Jerome Powell could come out and save us, right? All right, let's do a poll. We're pretty established now. It's been 7 minutes since the event has happened, or the decision has happened to pause rates. Really quickly, let's do another poll on the man, the myth, the legend, Jerome Powell. SPY is kind of stuck as of now, okay? All right, getting the poll. All right, there's only 3 ways it could take us. We could either go back into the green, into the red, or sideways / neutral again with Jay Powell. And him speaking. I am extremely curious to hear what Jerome Powell has to say about all of the future rate cuts. You guys already know those rate cuts are going to be crucial coming up. Very, very important. Red Februaries are usually one of the worst months of the year, Jane said. Oh, that's no good. We have seen a lot of historical data that suggests that. As well as even VIX. Don't worry, though. We're going to be looking at a whole bunch of those coming up soon. Patrick said, hopefully better than last month. Yeah, right? I love SPY here, though, at 599, 600. It's going to be crucial. Tango is both a military term for target and a really suggestive dance. I like the military version more. What's your thoughts on RCAT? RCAT. You know, RCAT's not terrible. Let me pull this up here on a separate monitor. You're gonna tango with Tangy, that's right. RCAT's a pretty wild stock. Looking at it in the short term, I think it's one of these growth stocks that's gotten a little bit too overblown in the short term. I think it's gonna go a little bit more negative here as time goes forward, but SPY just made a new low of the day. There it goes by 1 minute on the 1 minute chart. Let's go, Spy, Jeanette said. And she put a down arrow. That's how you do it. If your Discord tells when to exit options, contracts would have helped a lot. Yeah, definitely. Just, keep learning, keep putting work into learning options, learn support resistance, start to learn how to exit trades yourself. Getting that education is very, very important into actually becoming a better trader instead of just a follower. Let's go see Tesla here. Down around the 385 support. If Tesla starts to give out at 385, guys, it's going to get brutal. Let's check it on the bookie. The book map on 385 Tesla. Wow. Not the most ever, like 21,000, but 380 has a ton stacked up, 170,000 shares. That's quite a bit down there. We are 15 minutes out from the man, the myth, the legend, JP. How's the music? Is it a decent volume and everything? Let's go. Make sure you guys are liking up the stream. 22 likes. We got to get that number higher here. In the words of Matthew McConaughey, those are some rookie numbers. That's right.
60% of the time, it works every time.
Oh, does it? I heard that too. I'm nervous, Shane said. Yeah. Don't be nervous. It's okay. I love the music. Mike corrected to Tom. Love that. I've never seen someone correct it afterwards. Let's go. AK's out here looking for his girlfriend. Oh, she's here. I was saving her just for you.
How dare you?
Greta. She's gonna get pissed at Powell later. Don't worry. She's mad at him because he won't move interest rates based solely on climate. She wants him to use more climate initiatives. Jerome Powell and his calls, right? QQQ moving down towards the low of the day. SPY going back to it. Looks even worse. It actually broke the low of the day. About to go down even more. Rook said, are you going to play the song? Don't worry, Rook. We've been getting it ready. It's up. We got time. We got time. We got time. Let's go. QQQ moving down. Keep watching SQQQ. Starting to extend up in a pretty good way. UVXY is going to be popping up as well. SQQQ might be more consistent if tech truly does drop here. Heard the beautiful sound. Savage coming in. Thanks for putting this on, Tom. Let's go. Hell yeah, Savage. Thank you, sir. Thanks for all the kind words and everything in Discord always. Let's go. We're going to go buy a Big Mac tomorrow with that. Appreciate ya. Let's go. Tesla on the way down, Jeanette said. TSLA, another one that could be fun. I'm sure traders are going to be watching TSLL. Both tanking. TSLA, though, 3.16%. What is the inverse Tesla one that's like TSLL? What's that one called? TSLS? Haha, there is a TSLS. That's funny. That is hilarious. Gonna go back to Boeing here. Check back in. How about Lockheed Martin? What about some of the defense stocks today? Raytheon. Not too much there. China stocks have been hot in the short term. BABA, double bottom, down around 96.50 on the day. That's a pretty big double bottom. Hell yeah, trust in the DJ. All right.
Again, I implore you to remember, fuck your puts, fuck your calls. Jay Powell has you by the balls. God bless my money printer.
Let's
Again,
go, JP.
I implore you to remember, fuck.
JP is a wild man. Can you believe it? This is insane here. "10 minutes. The man, the myth, the legend." We'll have him live right here, side by side with the stock market. We'll have Spy there too, don't worry. We won't miss out on the Spy. It'll be there. Let's see what changed in the new Fed statement. All right. They said since earlier in the year, so instead of saying have generally eased, now they said remain solid. Now they're saying inflation, instead of saying has made progress towards their 2% objective, now they're saying inflation remains somewhat elevated. Whoa. So they're just saying inflation remains somewhat elevated. So they took away the whole made progress, but, and then they just kept remains somewhat elevated. So, sounds a bit weird there. They decided to maintain, pause, right? Yep. A lot of differences there. All right. Not too many, but, you know, some key ones, right? Most of it's the same in the third or the fourth paragraph, I should say. Make sure you guys are destroying that like and subscribe button today. But I know today's going to be a wild day. The SPY so far is falling down. It's not what traders want to be seeing, right? We're seeing a pretty bad downtrend hitting the market here. Right after the interest rate decision. Now, is it the worst pullback in the world? No, it's not. It's not the worst. But it's also not the best. A lot of traders might suggest that we might need a hero today. It's not over yet. There's a little bit left, but we're ending it there. Let's go. The tradition lives on, guys. That is Jay Powell's theme song here on the Stocked Up live stream. We're about 5 minutes out. We always go live here with Powell for these events. For those of you that don't like the tradition, I'm sorry, but it lives on. Let's go. All right, SPY actively moving lower still, down to around 599. Hope is not lost, though. The move under 600 is not too massive yet. We could still come back. The big concern would be is if we start to see a true drop from Powell's speech here. If we start to see the low from today give out 599, and even more specifically in the short term, there's this recent dip on the SPY, which is showing higher lows coming into play. It's right around 597.30. If we end up breaking under that, that is going to be a very big spot on the SPY chart to look for. It's the bottom from yesterday, 597.30. That low from yesterday will end up being very important down there if we get the breakdown. Overhead, as far as big resistance, I really like 605 is major. I've had it on the chart for a while, and then I really like the gap fill zone up to 607. This 607 area just above 605 is going to be pretty crucial. But there's a lot going on here right into this event. We've been having a lot of weird price action today. We had the Trump officials discuss tightening curbs on NVIDIA. China sales, restricting NVIDIA chips and stuff. Got weird stuff with that going on. Refresh that really fast. The Fed removed reference to inflation making progress towards their goal. Yup, that's what we just looked at. That was a pretty big deal. But this is major. And then, of course, tonight, you know, I'm going to have the big man up here live in a minute, but I got to talk about this for tonight as well. You know, we're going to have big earnings. Tesla, Meta, Microsoft, all reporting tonight in after hours. So it's going to be a big night as well. Not only are we going to have a big day here with JP and this decision, but the earnings tonight could end up dictating even more of the price action, you know? Let's go see Tesla, Meta, Microsoft. Tesla has been pretty rough today, moving down, actively lower. It's below the low of yesterday, actually. Right now, as we watch it, Meta itself has been hot in the short term, and actually today, not too bad. Pretty bearish overall today, but I will say holding up way better than most other stocks today. That one's kind of surprising, but then Microsoft almost has the same setup as Meta, but that dip from Friday, just that gap down into this week was terrible, but notice Meta got even back above that. It's shown a lot of strength in the short term. Don't worry, guys, I have JP here. The man, the myth, the legend. JP going side by side. Wait till he comes out and get it looking a little bit better. All right, JP, where you at? Come on, JP. I'm going to throw on a different stream in case the CNBC one's bad again. Let's check Yahoo Finance. At least Yahoo Finance has it with them already there. All right.
Let's go to the beach, eat, let's go get a wave. They say what they gonna say. Have a drink, clink, found a Bud Light. Bad bitches like me, it's hard to come by. The Patron, let's go.
Meta. Short term, really starting to sell back down too. Save us, JP. Yeah, Harold, I don't know. It's just switching around to a bunch of different songs. Sorry, Harold. That was something with Nicki Minaj or something. We're going with some hits of the 2010s today. Y'all nervous or excited, Landon said. Both. Does both count? Yeah, you like it, Blurred? Oh, look who it is!
Good afternoon. My colleagues and I remain squarely focused on achieving our dual.
I'll boost this
goals,
sound, don't
maximum
worry.
Employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer-run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Mr. Chairman, Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a three-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if any, does a president making these kind of remarks have on policy? Thank you.
Three questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated this demand to you?
I've had no contact. Thanks.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was meaningfully restrictive. Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed. I mean, a couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So we really look at movement toward the goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive. And for that reason, we're going to be focusing on seeing real progress on inflation or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates? And would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market to achieve that goal, and that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance. And I'd say you look at the last couple of inflation readings and you see we don't overreact to two good readings or two bad readings, but nonetheless, the last couple of readings have suggested more positive readings. So I think policy is well positioned.
Colby from the New York Times. Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
No. So let me look. If you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market, and we just chose to shorten that sentence. Again, I mean, if you look at the sort of intermeeting data, it was good, and there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret two good or two bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
Follow up. We've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer end, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy and with regulatory policy. We're only just beginning to see, actually are not really beginning to see much. And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do. This is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand, and kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
Michael McKee from Bloomberg Television and Radio. You and your colleagues normally condition future policy moves with the phrase, if the economy develops as we anticipate. Is it fair to say that since there's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing?
Well, at all times, forecasts are conditional at a minimum on just a set of expectations, and they're highly uncertain in both directions. We know that economic forecasting is really difficult beyond just a month or two out. So in the current situation, there's probably some elevated uncertainty because of significant policy shifts in those four areas that I mentioned: tariffs, immigration, fiscal policy, and regulatory policy. So there's probably some additional uncertainty, but that should be passing. We should go through that, and then we'll be back to the regular amount of uncertainty. So, what forecasters are doing, not just us, but everybody's doing, is they've got sort of just a set of assumptions about what might happen, but they're really kind of in the nature of a placeholder. And meaning, plausible could be, but honestly, you wouldn't stand behind it because you just don't know. And so you're just on hold, waiting to see what comes down. It's a very large economy, and policy is affected at the margin. But we're going to wait and see.
If I can follow up, the idea that you feel that policy is restrictive suggests that the Fed, in general, wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you can cut, or data that will tell you you should hold?
We're looking. It's more the other. The way it works is we are looking at the data to guide us in what we should do, and that's what we do. And right now, we feel like we're in a very good place. Policy's well positioned. The economy's in quite a good place, actually, as well. And what we do expect is to see further progress on inflation. And as I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster. We could then be in a position of making further adjustments. But right now, we don't see that, and we see things as in a really good place for policy and for the economy, and so we feel like we don't need to be in a hurry to make any adjustments.
Howard Schneider with Reuters. Thank you very much. In 2021 at a central bank conference, you said, quote, throughout my career in both public and private sectors, I've seen that the best and most successful organizations are often the ones that have a strong and persistent commitment to diversity and inclusion. These organizations consistently attract the best talent by investing in and retaining a world-class workforce. First question is, do you still believe that? And if so, how do you intend to put that belief into practice while remaining consistent with the recent executive order prohibiting diversity and inclusion efforts?
So let me say yes, in answer to your first question. But to the second question, I want to say this. We are, like others, we're reviewing the orders and the associated details as they're made available. And as has been our practice over many administrations, we are working to align our policies with the executive orders as appropriate and consistent with applicable law. And I want to add that I'm not going to have anything more specific for you today on this whole set of issues.
Well, if I could just follow up quickly on that, I'm wondering how you're getting that to be consistent with the Dodd-Frank law's stipulations about maintaining an Office of Minority and Women's Inclusion.
So I did mention consistent with applicable law, right?
Which is governing.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. Just to follow up on Steve's question, what reassurance can you give the American public that the Fed will continue to operate independent of politics under this administration?
You know, as I've said countless times over the years, this is who we are. This is what we do. We study the data. We analyze how it will affect the outlook and the balance of risks, and we use our tools to try to, given our best understanding, our best thinking, try to achieve our goals. That's what we do. That's always what we do. Don't look for us to do anything else. And that's, you know, lots of research shows that's the best way for a central bank to operate. That'll give us the best possible chance to achieve these goals for the benefit of the American people. That's always what we're going to do, and people should have confidence in that, as I said a few minutes ago.
You've said that the Fed is in wait-and-see mode based on the policies that come out of this administration. Has the Fed started to model what policies like mass deportations, changes in immigration policy specifically, would look like for the workforce and for inflation?
So one of the things our staff does is they look at a range of possible outcomes, and they tend to go from really good to really bad, and that, you know, that it's one of the best things that they do. And in each teal book, you can look at the 5-year-old teal books and see there are alternative simulations. So that's what they do. There'll be a baseline, and then they'll show 6 or 7 alternative scenarios, including really good ones and not so good ones. And what those do is they spark, you know, the policymakers to sort of think and understand about the uncertainties that surround this. So yes, the staff does that, and we're all well aware that that the range of possibilities is always broad, and not just now but always. And it's hard to be open to just how broad the possibilities are for an economy. You know, no one saw the pandemic coming, and it changed everything. So things happen, but yes, we do that. But it's different. It's one thing to do that, to make assessments about what might happen and begin to think about what you might do in that case. But you don't act until you see much more than we see now.
Katerina Saraiva, Bloomberg News. You know, last month you talked about a future rate cut as being pretty, significantly predicated on more progress in inflation. With the characterization of the labor market in the statement today, would you say that that's even more so the case now?
I'd say it's the same. You know, we want to see, further progress on inflation. And, the story's there. We're just going to have to see the data. At the end of the day, it comes down to 12-month inflation, because that takes out the seasonality issues that may exist. And, we're just going to need to see that. We think we see the pathway for that to happen. One example, a key example, is that you now do see owner's equivalent rent and, housing services, the way it's calculated for PCE. You see that coming down pretty steadily now. And that's the place where most of the remaining gap is. In addition, a big part of the overrun, as you will know, was from non-market services, which don't tend to send much signal. So you can look through all that and think, okay, then we seem to be set up for further progress. But being seemed to set up for it is one thing, having it is another. So we're going to want to see further progress on inflation. Remember, we're not, we're under 2%, but our goal is 2%, and we do mean to get back sustainably to 2%.
And in terms of the labor market, I mean, how is that broadly, you said a broad set of indicators show that it's in pretty solid place. Was there broad agreement on that? There's been a few underlying indicators that are showing perhaps some weakness, a low hiring rate, workers reporting that it's increasingly difficult to find a job. Is that of concern to the committee?
So you're right. I mean, we look at, of course, a very broad range. So it starts with unemployment, the unemployment rate, employment participation, wages, job quits, are people quitting, that kind of thing, the ratio of vacancies to unemployed. We look at all those things, and you put your finger though on it's a low hiring environment. So if you have a job, it's all good. But if you have to find a job, the job finding rate, the hiring rates have come down, and that's more typical of a, let's say that the unemployment, that the labor market is at a sustainable level. It's not overheated anymore. We don't think we need it to cool off anymore. We do watch it extremely carefully. It's one of our 2 goal variables. But yeah, I'd say we watch those things quite carefully. But nonetheless, overall, look at the aggregate data in the labor market. It does seem to, the labor market does seem to be pretty stable and broadly in balance when you've got an unemployment rate that has been pretty stable now for a full half a year.
Thank you. Thank you, Mr. Chairman. Edward Lawrence with Fox Business. On employment, now you said there's a broad range of possibilities, but last September you said, quote, "We understand that there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise." Now that the flow of the border has slowed and we're seeing deportations, how do you expect the unemployment rate to react?
You know, so what's happening is that the flows across the border have decreased very significantly, and there's every reason to expect that to continue. And so, but job creation has come down a bit too. So, you know, if those 2 things come down together, that sort of can be a reason for the unemployment rate to stabilize. In other words, the break-even rate, as population growth slows, the break-even rate that you need in new jobs to make make jobs for workers declines as well. So that seems to be something about what's happening. You do see a very flat unemployment rate at a time when you've seen significant declines.
I want to ask you about Fed employment. I know that tax money is not used here, but Elon Musk alleges that the Fed is, quote, absurdly overstaffed. We've seen the executive branch push to reduce the federal workforce. I just want to get your reaction.
You know, we run a very careful budget process. We're fully aware that you know, we owe that to the public, and we believe we do that. And I've got no further comment than that. Thanks.
Chris Rugaber at Associated Press. President Trump has said he will lower inflation by reducing gas and energy costs. Do you see such costs as a particular driver of inflation, and would lowering them have a dramatic effect?
Chris, I'm not going to react or discuss anything that any elected politician might say. So I'll give you a mulligan.
Okay, thank you. Well, nearly 2 weeks ago, the Fed said it was withdrawing from the network for greening the financial system, even as we have significant wildfires in Los Angeles doing billions of dollars in damage. And of course, the NGFS, as you know, is a group to talk about how the financial system could address climate change. Many commentators did see the timing as political. Why did you leave that organization? Can you explain that decision?
Sure, I'd be glad to. So we considered this, really at length, and we did decide to withdraw from the NGFS. And really the reason is that the work that the NGFS does has broadened very significantly. Think about nature-related risks and biodiversity and things like that. In addition, the work of the NGFS is in significant part intended to, and this is a quote, mobilize mainstream finance to support the transition toward a sustainable economy. So we joined to get the benefit of understanding what other central banks were doing and seeing research and things like that. I think this is just way beyond any plausible mandate that you could attribute to the Fed. And so we have a quite narrow role, as I've said many times, and I think that the activities of the NGFS are not a good fit for the Fed, given our current mandate and authority. So, and I just think it was time to acknowledge that. This process dates back, thinking about it dates back a couple of years. I made the decision to bring this to the board, some months ago. The process just took time to get here, and this is when we got it and voted on it. So, and I'm aware of how it can look, but it was really not driven by politics. It was driven by kind of the disconnect between the work of the NGFS and our mandate. Other central banks have different mandates and belong to the NGFS. We have no criticism of them, but it just isn't, it's not right for the Fed.
Andrew.
Thanks. Andrew Ackerman with the Washington Post. I'm wondering if you could talk more about what further progress would look like for consumers.
Well, 2% inflation down to 2% sustainably is what we're trying to achieve. We're somewhat above that, as you know, and we want to see serial readings that suggest that we're making further progress on inflation. That's what we want to see, and consumers will pick that up course, in the things that they buy at the grocery store or at the store.
The other thing I wanted to ask was just how far away you think you are from neutral.
Yeah, you can't know with any precision, of course. As I like to say, that you know the neutral rate by its works. So I think, at 4.3%, we're above pretty much everyone on the committee's estimates of the longer run neutral. I think our eyes are telling us that our policy is having the effects on the economy. That's really the question we ask. You can consult models, empirical models, theoretical models. You really have to just look out the window and see how your policy rate is affecting the economy. And I think we see that it's having meaningful effects in bringing inflation under control. It has helped bring the labor market into balance as well. So that's what we think. I would say we're meaningfully above it. I have no illusion that anyone knows precisely how much that is. But not knowing that and having cut 100 basis points means that it's appropriate that we not be in a hurry to make further adjustments.
Victoria. Victoria Guido with Politico. So as a general matter, when it comes to executive orders and OMB memos, do those always apply to the Fed, sometimes never, or do you just often voluntarily comply? What is the legality there?
So it's been our practice, as I mentioned, to work to align our policies to those that are mentioned in the executive orders, and I'm just going to leave it at that. As I mentioned, I'm not going to go any deeper than that or get into any deeper into this set of issues today.
Claire Jones from the Financial Times. Two questions, if I may, on tariffs. Well, first of all, we've seen global trade wars before, notably in 2019, last time around, but then we were in a very different place on both inflation and growth. If we see tariffs of the same sort of magnitude that we got then, which I know is big if, what do you think might be different this time around? And secondly, Tiff Macklem said there was no doubt that the threat of tariffs was a big driver of the cut by the Bank of Canada today. What sort of information would the Fed need to see on tariffs before it was willing to take such a preemptive move? Thank you.
Sorry.
What sort of information would you need to see on tariffs? Would you need to see a strategy, actual implementation, actual movement of inflation expectations before you're actually willing to change the path of monetary policy on the basis of it?
Yeah, so first of all, things are a little different now. We've just come through a high inflation period, and you can argue that both ways. You can say that companies have figured out that they do like to raise prices, but we also hear a lot from companies these days that consumers have really had it with price increases, and so I don't know how that shakes out. Nonetheless, you're coming through a situation where we're not quite back to 2%, and that's just different. In addition, the kind of footprint of trade has changed a lot as trade is now spread around. It's not as concentrated in China as it was. There was a lot more manufacturing. It moved to Mexico and other places. So there are differences, and I just think the range of possibilities is very, very wide. We just don't know, and I don't want to start speculating, as tempting as it is, because we really don't know. And we didn't know, by the way, in 2018. We didn't really know. And the range of possibilities very, very wide. We don't know what's going to be tariffed. We don't know for how long or how much, what countries. We don't know about retaliation. We don't know how it's going to transmit through the economy to consumers. That really does remain to be seen. There are lots of places where that price increase from the tariff can show up between the manufacturer and the consumer. Just so many variables. So we're just going to have to wait and see. And the best we can do is what we've done, which is study up on this and look at historical experience, read the literature, and think about the factors that might matter. And then we'll just have to see how it goes.
Thank you. Courtney Brown from Axios. Two unrelated questions. The first is whether or not there was any discussion about QT and the timeline for ending QT at this meeting. And then the second question is just, I wonder if the AI-prompted sell-off in the stock market this week signaled anything to you about the state of financial conditions?
So let's talk about runoff. So the most recent data do suggest that reserves are still abundant. Reserves remain roughly as high as they were when runoff began, and the federal funds rate has been very steady within the target range. We track a bunch of metrics, and they do tend to point to reserves being abundant. We do intend to reduce the size of our balance sheet to a level that's consistent with implementing monetary policy efficiently and effectively in our ample reserves regime. We're closely monitoring a range of indicators to assess conditions, and that should provide signals whether reserves are approaching a level that could be judged as, quote, somewhat above ample. I don't have anything to say to you about particular dates. It's just that's the process, and what we see is that rates do appear to be abundant. As always, we stand ready to take appropriate action to support that smooth transition of monetary policy, including to adjust the details of our approach for reducing the size of the balance sheet in light of economic and financial developments. On AI, it's a big event in the stock market and in particular parts of the stock market. I mean, what really matters for us is macro developments, and that means substantial changes in financial conditions that are persistent for a period of time. So I wouldn't put that label on these events, although, of course, we're all watching it with interest.
Simon Rabinovich with The Economist. Thank you. You mentioned in your remarks that activity in the housing sector seems to have stabilized. At the same time, since your first rate cut in September, long-term mortgage rates have gone up by a full percentage point back above 7%. I'm wondering, kind of looking forward, are you confident that activity will remain stable given how elevated mortgage rates are? How does it fit into your broader thinking about the economy?
So, as you know, as we've reduced our policy rate 100 basis points, longer rates have gone up, not because of expectations, not principally because of expectations about our policy or about inflation. It's more a term premium story. So, and it's long rates that matter for housing. So, I don't think I think these higher rates are going to they're probably hold back housing activity to some extent if they're persistent. We'll have to see how long they persist. So. We control an overnight rate. Generally, it propagates through the whole family of asset prices, including interest rates. But in this particular case, it's all happened at a time when, for reasons unrelated to our policy, longer rates have moved up.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you want to see further progress on inflation. Given that households appear to be unhappy with the elevated level of prices, do you believe the committee should wait until inflation has fallen back to target to cut rates again?
No, I wouldn't say that. We've never said we need to be all the way at target to reduce rates. At any time, what we're doing is we're looking at the economy and asking whether our policy stance is the right one to achieve maximum employment and price stability. So I think if we would want to see further progress, but we think our, as I mentioned, we think that our policy stance is restrictive, meaningfully restrictive, not highly restrictive, but meaningfully restrictive. And so I would think we need to see further progress. I wouldn't say all the way back down to 2% on a sustainable basis, although we'd love to see that, of course, and we will.
And separate question for you on tariffs. Curious whether the threat of tariffs and not knowing whether they could stick or not creates uncertainty for business here in the United States and could cause them to pull back, ultimately weighing on growth. Does the threat of tariffs cause you to ponder your growth forecast?
I want to avoid commenting even indirectly on the conduct of tariffs. It's not our job, and it's not our job to comment on the moves that people make. So I wouldn't want to criticize anything that's happening or really comment on it one way or another, praise it for that matter. It's just not our job. I do think that, we found in 2018, there was a lot of work done on trade policy uncertainty. Trade policy uncertainty, if it's large and persistent, can start to matter for businesses making investment decisions and things like that. That's not something I'm observing today. It's very early days for this, but I think that did matter in 2018-19, and it's one of many things we'll be watching.
Matt.
Thank you, Chair Powell. Matt Egan from CNN. Following up on Courtney's question from earlier about the stock market, how concerned are you, if at all, about potential asset bubble brewing in financial markets? How do relatively high market valuations factor into considerations about potentially lowering interest rates further? Is that something that's in the back of your mind?
This is good.
So we look at, from a financial stability perspective, at asset prices generally, along with things like leverage in the household sector, leverage in the banking system, funding risk for banks and things like that. But it's just one of the four things asset prices are. And yeah, I'd say they're elevated by many metrics right now. A good part of that, of course, is this thing around tech and AI. But we look at that. But we look at how resilient the households and businesses and the financial sector are to those things. So we look at that mainly from a financial stability perspective, and we think that there's a lot of resilience out there. Banks have high capital, and households are actually overall, not all households, but in the aggregate, households are in pretty good shape financially these days. So that's how we think about that. We look at overall financial conditions, and you can't just take equity prices. You've got to look at rates too, and that represents a tightening in conditions with higher rates. So overall, financial conditions are probably still somewhat accommodative, but it's a mixed bag.
Hi, Chair Powell. I'm Richard Escobedo with CBS News. One question for you. This month's statement notes that unemployment is stabilized at a low rate and that the labor market is solid. You walked through some of what's driving this, but I wonder what risks you see that might challenge your assessment.
Well, the things we discussed earlier, one is that there's a low hiring rate. And so that if there were to be a spike in layoffs, if companies were to start to reduce headcount, you would see unemployment go up pretty quickly because the hiring rate is quite low. So that's one thing we look at. I think it's worth pointing out that for lower income households, they're under significant pressure. And in the aggregate, the numbers are good, but we know that people at the lower end of the income spectrum are struggling with costs. And really, it's high inflation for the basics of life. It's not so much the inflation now, it's the price level. Because inflation has raised prices. Inflation is now much closer to target, but people are really feeling that. But overall, this is a good labor market. You're at 4.1% unemployment. That's just a really good level, and you've been solidly there now for 6-7 months. And job creation is pretty close to a level that will hold the unemployment rate there, given that there'll be much slower population growth.
One more question. Some of the uncertainty around immigration policy, is, in your assessment, is that making it harder for businesses and the Fed to plan going forward?
We hear anecdotal reports, but I don't see, there's nothing in the data yet on that. But you hear that kind of thing about construction, for example, and businesses that are dependent on immigrant labor are saying that it's suddenly gotten harder to get people. But you don't see that in the aggregate data yet, but yes, you hear it anecdotally.
Thank you, Chair Powell. Nicholas Jasinski from Barron's. The uncertainty is certainly a theme today, and I'm wondering, are there any periods from your career or as it relates to markets, the economy, what's going on here in Washington and beyond, or from lessons from history that may provide some guidance for a central banker operating in uncertain times like today?
I guess I'd say this. Uncertainty is with us all the time. It is human nature, apparently, to underestimate how fat the tails are in a way. You know, the possibility, we think of things in a normal distribution, and in the economy, it's not a normal distribution. The tails are very fat, meaning things can happen way out of your expectations. It's never not that way. I wouldn't, you know, if you think about it, think about the first few months of the pandemic. That was uncertainty. Are we going to be able to reopen the economy? If so, when? How much of it? How long will it take? You know, that was uncertainty. What we have now is a good labor market. We have the economy growing at 2 to 2.5%. Inflation's come down to now the headline inflation number was 2.6, and that's what the public experiences. We look at core because it's a better indicator of future inflation. So yes, the price level went up a lot for inflation, and people are feeling that, and they're not wrong. But so the kind of uncertainty we have is just a usual level of uncertainty about the economy, but then policies which are not for us to criticize or praise, really. Those are policies which people have been elected to implement. They're implementing them with a view to making a better economy. And so I don't think, I wouldn't call this out as one of those times. I wouldn't compare it to the global financial crisis or anything like that, given that we have actually a very good economy right now.
Evan Reiser with Market News International. Chair Powell, is a March cut still on the table? And then additionally, are you looking to see better than expected data on inflation to cut? Or are you looking for inflation data that roughly aligns with current forecasts?
So as I mentioned, the economy's strong, the labor market's solid. Downside risks to the labor market appear to have abated, and we think disinflation continues on a slow and sometimes bumpy path. That tells me, and the other members of the committee, the broad sense of the committee actually is that we don't need to be in a hurry to adjust our policy stance. Your second question was?
Whether or not you need to see better than expected inflation data or just inflation data that roughly aligns with your current forecasts?
You know, it's one of those things, we'll know it when we see it, but more the expectation is that we will make continued progress. And, that's what we want. We'll know it when we see it. It's going to have to be something that isn't just idiosyncratic. You're going to want to see, continued progress with housing services inflation. You're going to want to see inflation behaving in a way that builds confidence that we are really making progress. That's what it's going to be. And I mean, is that better than our expectations? We expect to see that. It's just a question of when.
All right, Powell, let's get this over with.
Hi, Chair Powell. Scott Horsley from NPR. In your 5-year review, you said the 2% inflation target won't be on the table. Can you talk a little bit about why? Is that because you think that's the right target, or is it because you don't want to move the goalpost mid-game, or what's behind that?
I think that goal has served us well over a long period of time. It's also the sort of global standard. I think that if a central bank wanted to look at changing that, you wouldn't do it at a time when you're not meeting it anyway. I would not look at changing it anyway, but I certainly wouldn't look at it at a time when you're not meeting it. I mean, there's just no interest at all in changing it. If I'm being at all unclear, we're not going to change the inflation goal anytime soon.
And 5 years ago, if I can paraphrase what y'all decided, it was you're going to not raise interest rates preemptively to head off inflation until you see sort of the whites of the eyes of inflation, because the solid labor market was so beneficial. Have the last few years changed your thinking about that?
So what we really said was that we wouldn't look at a strong labor market and raise rates unless we saw some evidence of inflation. So the thought was that we'd seen really low levels of of unemployment with no sign of inflation. So why would you preemptively want to put people out of work in the absence of any kind of any evidence that suggested that this was not a sustainable level? It was a way of acknowledging how much humility we have about the starred variables, especially U-star, the natural rate of unemployment. So that was an insight. We'll discuss that again. That'll be one of the many things that we discuss. But I don't think that insight is wrong. We didn't. We said what we said was that at times when inflation persistently undershot 2%, we would likely allow inflation to run moderately above 2% for some time. That's what we said. That turned out not to be relevant to what actually happened. There was nothing moderate about the overshoot. It was an exogenous event. It was the pandemic, and it happened. And our framework permitted us to act quite vigorously, and we did once we decided that that's what we should do. The framework had really nothing to do with the decision to. We looked at the inflation as transitory, and right up to the point where the data turned against that. And when the data turned against that in late 21, we changed our view and we raised rates a lot. And here we are at 4.1% unemployment and inflation way down. But the framework was more irrelevant than anything else. That part of it was irrelevant. The rest of the framework worked just fine as we used it, as it supported what we did to bring inflation down.
Go to Mark for the last question.
Hello, Chairman Powell. Mark Hamrick with Bankrate. As you know, in the annual report from the Financial Stability Oversight Council, among the risks outlined is cryptocurrency. Could you talk about those risks now? And regarding individuals and households, perhaps distinct from the concern about the financial system, do you worry that speculation in this unregulated asset class could hurt their financial well-being, or do you think it has a place in a household's portfolio?
So our role with Bitcoin really is to look at, with crypto, really is to look at the banks, and we think it's, banks are perfectly able to serve crypto customers as long as they understand and can manage the risks, and it's safe and soundness. A good number of our banks that we regulate and supervise do that. The threshold has been a little higher for banks engaging in crypto activities. And that's because they're so new, and we don't want to make the mistake. If you're making a choice to conduct that activity inside a bank, which is inside the federal safety net with deposit insurance, then you want to be pretty sure that it's a safe and sound activity. So, we're not against innovation, and we certainly don't want to take actions that would cause banks to terminate customers who are perfectly legal, just because of excess risk aversion may be related to regulation and supervision. So.
And with respect to households and their inclusion in that asset class?
That's kind of it's not really our bailiwick. You want people to be knowledgeable about the financial engagements that they have, and that's why we have the securities laws that we have. It's why if you read a mutual fund prospectus or individual stock prospectus, you want households to have the chance to understand the risk that they're taking. And I do think it would be helpful if there were a greater regulatory apparatus around crypto, and I think that's something Congress was working on quite a lot. We've actually spent a lot of time with members of Congress working together with them on various things, and I think that would be a very constructive thing for Congress to do. Thank you.
All right, there we go. Finally, Jerome Powell. What a long speech that one was, right? That was a long press conference. Wow, let's go, JP. Oh, wow, the SPY is going all over the place right now as well. And when I say all over the place, I mean it. I mean, we saw some downwards action. We saw some upwards action. I would say for the most part, I'm leaning to the upside here, given how the SPY has held its ground around 600. This is one thing that I was looking for here into this event, was for $600 and for the low of day today to hold up. Right after the interest rate decision happened, we actually did see the SPY break the low of day just momentarily, but then it came right back to the upside and ended up having a pretty good move right back. And now we're sitting right around 602. Looks like it might come up to maybe test 603 here, but Let's see what we can get here to end the day. Maybe JP will get us up in the green if the SPY does go green. Again, I'm watching resistance up around 605. That will be huge as we start to break out above the highs from today. And then, of course, the gap fill zone from Monday, which is right around 607. So be ready for that if we do see this continued move higher here. So far, so good. But wow, I hope everybody has a fantastic rest of their day. If you're new here, make sure you're subscribed. If not, definitely destroy that subscribe button. Definitely helps us out here on the channel. This is separate from the nightly one. So get that subscribe posted up. But I appreciate you. Thank you guys. Have a fantastic rest of your day. And I will talk to you later. I hope to see you in the Discord. We have the live Q&A going on tonight, so don't forget about that. You have to be a trading floor member to be at the live Q&A. Just sign up using the link I posted in the chat. This will give you access to the trading floor, and you can join up and ask Mike any question you want, and you can have it answered. It's an awesome time to learn some new trading strategies. But let's go. Have a great one. Tomorrow's Thursday, 2 days left this week. The SPY right around 603. Will we be able to break the high of this week? That'll be a huge question coming up tomorrow. See you guys later.